Good morning and welcome to this Wednesday, March 3rd, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Um, Interesting day yesterday for sure in the market. We're going to get into all of that in just a couple minutes, but definitely a little bit of a roller coaster ride, a couple of stocks in particular that I'll be talking about. Um, I still think that clearly we're in an uptrend. I'm very, very bullish going forward. But March is certainly giving us more and more signs that it's probably going to be more of a consolidatory month as opposed to one that just keeps going higher. I could be wrong. I mean, on the one hand, I kind of hope I'm wrong. On the other hand, a little bit of sideways consolidation and a base wouldn't be a bad thing before our next quarter's earnings reports start coming out in about 6 weeks. So, we definitely have some things to think about and discuss. But before I get into any of that, I do want to take anyone that's new over to earningsbeats.com. Make sure you're familiar with what we do. We do offer a free newsletter, Earnings Beats Digest, delivered Mondays, Wednesdays, and Fridays directly to your email. Normally is out well before the market opens at 9:30. We try to talk in the EB Digest about things that are important to us at Earnings Beat. So you see a lot of relative strength talk, a lot of earnings related talk, discussion, and so forth. But I think the key really is the relative strength. And so we try to hammer that home. Occasionally we have some trading ideas. Actually, I would say more often than not, it's a trading idea that is passed along. But if you're interested, it's free. There's no credit card required. And you can unsubscribe at any time. Just simply type in your name, email address there, hit the subscribe button. If you'd like to check out our service, we offer a no-cost 30-day trial. You do sign up for $7, but we refund you the $7 within about a week. So basically 30 days is for free. And you can check out some of our portfolios and how they've performed over the course of the past couple of years since their individual inception dates. I think you'll be pretty impressed with some of those results. But a lot of that's based on our fundamental core beliefs of following earnings and relative strength. I mean, that's the key. And then the portfolios also there's diversification in the sense that you don't have more than one stock within one industry group. But it's not like we're trying to pick one stock within every sector. If a sector is underperforming or we believe it may underperform, we really don't want to be in that area of the market. So it is concentrated. We're in a secular bull market, so they're going to be somewhat concentrated, quite a bit concentrated, I should say, in the more aggressive sectors, particularly technology, consumer discretionary, and communication services. But anyway, love to have you check that out. All right, let's move on, talk a little bit about what happened yesterday. So we finished with the Dow Jones Industrial Average down 144 points. The S&P was down 31. Another rough day of rotation in terms of NASDAQ performance, down 230 points after a huge rally toward the end of last week. More this week. It started on Friday, but more on Monday. We got that big opening push to the upside. Growth stocks were back in favor. Well, we saw that kind of die off again a little bit yesterday. And, I think the breakdown on that IWF, IWD relative chart that I show a lot, especially to our Earnings Beats members, I think that breakdown below 1.69 has spooked some folks. And I just think we're going to go through a period here. That's one of the reasons why I think we may do more consolidation and rotation. I still expect leaders to do well within the groups that, where we're invested in our portfolios. But I don't think it's going to be straight up. And I think even maybe for a period of time, we may lag the S&P 500 just because I think this rotation is not in our favor. In the short term. Longer term, though, I think we're going higher. And when I say higher, I mean the IWF versus IWD. I think growth does outperform value going forward. But we've got to go through this period. It's almost like, when you're in an airplane and they tell you to fasten your seatbelt because turbulence ahead. I think that's kind of where we are right now with the market. I believe we're going higher. We're going to get through that turbulence fine, but it's probably going to be a little rocky while we're going through it. Mid caps, you can see down 1.3%, small caps 1.7%. So across the board, it wasn't a very good day. As you can see, though, we remain above pretty well. We're in uptrends across the board. NASDAQ, I'm going to watch that 13,000 level pretty closely short term. We could certainly go beneath that. That would shake out a lot of folks who just are used to the market just going up all the time. But if it continues to hold 13,000, even in the short term, I think the market looks fine. If we break 13,000, though, I think that's where things could get a little dicey for a short period of time. Materials, you can see, was the leading group. And it was the only group, by the way, that was in positive territory on Tuesday. Technology and discretionary have taken their customary spot down at the bottom of the sector leaderboard. We've been seeing that quite a bit here over the last couple of weeks. That continued yesterday. Aluminum was one of the reasons why materials did so well. Aluminum up almost 6%. Pretty nice little pattern here on aluminum. Got the PPO pointing up, accumulation distributions come roaring back. And this move since really the end of January has been pretty powerful. I mean, we're talking 50% from 60 to above 90. So it's been a really big move in aluminum stocks, playing a little bit of catch up. And then to the downside, though, we're seeing renewable energy stocks struggle a little bit. And the biggest problem with renewable, well, I'm going to go through that chart. So let's hold off on that. We'll talk about renewable energy in just a couple minutes. Let's move on first to the 10-year Treasury yield. Let's get a quick update. We did have the February ADP employment report come out this morning. It was a little weaker than expected. I actually think it was a good report for the market because if it gets, if it's too hot, then folks start really getting in the camp of, hey, interest rates need to be, needs to shoot higher. But came in 117,000. Market was expecting 165,000. So I think this is saying, okay, the economy is getting back on its feet, but it's not exactly roaring, which I think is kind of where I like it to be right now. I think our growth is going to pick up later in the year, but I think this is a good number. It's not a great number, but I think that's okay. Friday's non-farm payrolls, the expected number is 140,000. January was 49, so we're looking for improvement from January, which is good. Quite a range, though. I was looking at the estimates, and the estimates are anywhere from minus 100,000 to plus 312,000, with the estimate being at 140,000, kind of in the middle there. I want to see a positive number. I think the 100 to 200,000 range would be a solid number for the market. I think the market would like that. I'm not saying short term we're not going to get a pullback or something, because I think in the short term the market's really difficult to predict unless you're seeing some things like negative divergences on the 60-minute chart, or rotation, is crazy going into, say, consumer staples versus discretionary. I mean, if those types of signals are really diverting from the direction of the market. So if the market were going up, let's say, and you see consumer staples leading it to the upside, that would be a problem. But we're really not seeing that. The market's kind of hesitating, pulling back, and it's okay if we get a little bit of leadership from defensive groups here in the near term. So I think we're still okay here in the market, but short term, again, I think fasten your seatbelts. That's kind of would be my short term suggestion. Later this morning, we're going to get the February PMI composite out. The expectation there is 58.8. January was 58.7. So we're not expecting much difference there. And then February ISM services is expected at 58.7. January was also 58.7. So again, not expecting much change there. All right, let's move on. Well, before I move on, the 10-year Treasury yield, you can see it's back up again. This is the first day after 3 days going down. It's back on the move to the upside. And that's definitely spooked futures. I don't know if you've looked, but futures were up okay earlier. Then we went tumbling down, and now they're trying to bounce back. Right now, we've got Dow futures up 37, but S&P is down 5.5, and NASDAQ's down 51. Actually just went to 53. So, with the discussion with the interest rates, do I think interest rates are going to be a problem? No, I do not. Not when you consider the growth that I believe we're going to get. I think the bigger problem, I think as long as we're raising rates because we're expecting growth, I think that's good. That's what we want. We don't want to not have growth and just continually rely on the Fed lowering rates to boost the stock market. I mean, we want companies to make more money. And so I think as long as the rates are going up in anticipation of a stronger economy, I think that's very bullish for equities. And long term, the correlation confirms that. The direction of the 10-year Treasury yield, normally that's the direction of the stock market. So when yields are going up like this, that's not a problem. Now, the one time it would be a problem is if the Fed starts coming out and saying inflation's a problem and yields are going up because of that, that could be a problem, a little bit more significant problem. I'm not going to say, hey, I'd run for the hills at the first sign of some inflation, because to be quite honest, the Fed's been trying to pump inflation in for the last several years. We want some inflation. We don't want deflation. We would much rather have targeted inflation. So a little bit of inflation is fine, and I would be okay. Even the Fed has said, hey, we'll take some inflation without raising rates. So it would take a little bit more than just a couple of, rough reports in terms of inflation to make me more nervous. But short term, again, this is just me, my opinion. I'm not paying any attention. In fact, I was predicting it a couple months ago or a month ago. We got past all the Reddit stuff, and I said, okay, here's your next news story that media is going to be all over. Interest rates are rising. But keep in mind, we're down near historic lows. 1.5%, just about at any point in our history, we would have loved to have had an environment where money was this cheap. But now all of a sudden it's become a problem because now we're not at zero anymore. But anyway, all right, let's keep moving on. So I wanted to talk a little bit about, what did I want to talk about? Okay, first thing I want to do is I want to talk a little bit about seasonality on some of the groups. And I mentioned technology, and I've been writing about some of this. I've been doing shows. I've been, writing my blogs, writing in the daily market report. So I can't keep track of where I've said it and who I've said it to. So I just want to make sure that I discuss this from time to time, because I think it's kind of a big deal. But if you go down and you find the seasonality on this drop down, and then just type in whatever you want to look up. I'm going to show you technology, for instance, and then go back the last 20 years, or I'm going to go back the last 10, which takes us back throughout the entire bull market, primarily. One thing that you have to realize as you go across here, and I've been doing this recently because the first 2 months of a calendar quarter tend to be much better than the third month. We just started the third month. So if you want to know one reason why I'm saying fasten your seatbelt, it's because of how we perform in technology and some of these other key areas in the third month of a calendar quarter. Remember, earnings now are pretty much in the rear view mirror. We're not close enough to the next earnings to have that pre-earnings run up. That's usually 2 to 3 weeks before we get into earnings season. So we're kind of in this no man's land where we just don't have anything to drive us higher. And then I think some of the negative news that comes out just kind of changes sentiment. Money starts rotating into more defensive areas. But look at technology in March, June, September, and December. So we've got 0.9%, 1.1, so that's 2% if you add them together. Add another 0.1, that's 2.1. Add another 0.4, and you're up to 2.5. So if you add the technology average returns for these 3 months for the last 10 years, you come up with 2.5%. Now do that same thing for the first month, 1.9, April 2.3, that's 4.2, July 3.7, that's 7.9, and then October 0.8, that's 8.7. Now that's the month where you're going to get the pre-earnings run up. Most technology companies start reporting the latter part of those months and into the middle part of the next month. And so if you look at that though, and go into the second month where you have February 2.5, May 1.8, that's 4.3, August 2.4, that's 6.7, November 2.9, that's 9.6. So I just broke this down for you, but the first month of each calendar quarter, if you add them up, January, April, July, October, that's 8.7%. Now you're only taking the average return for 4 months. So if you wanted an annualized, you'd have to multiply that times 3 to get to 12 months. So 8.7 times 3 would give you 26.1%. That's kind of your average annualized return for technology, just using those first months of each quarter. If we do the same thing for the second quarter or second month of each quarter, 9.6% was what we added up when we did February, May, August, and November. Multiply that times 3, and you get 28.8%. And then the final 3 months, if you multiply times 3, remember that was only 2.5%, times 3 is 7.5%. So just think about those numbers for a second. We're going back over the last 10 years, and we're breaking down the calendar months, within the quarters. And so if you're in the, the pre-earnings run-up phase, technology goes up 26.1% annualized. The actual earnings results phase, 28.8%. And then the no man's land phase, where there's just no news coming out, there's nothing really to anticipate, 7.5%. That's a big drop off in technology. So to the extent that we have technology, or that you own technology stocks, I've been talking about lowering your expectations. I think that's really important. If you've been on a roll and all of a sudden you go through a period where we're hitting this turbulence and you're not performing as well, or you're underperforming, it's part of the market. I mean, that, understanding the way the history of the market works, I just think it's important that we all lower our expectations a little bit here as we work our way through March. It's a little bridge to get to the next earnings season and April, and look at technology in April and May. Now, March doesn't seem too bad. I mean, 0.9%. Another way to look at this, by the way, is to compare it to the S&P 500. And I haven't done this in a while, but let's see over the last 10 years. Actually, March isn't too bad. Look at June. So June underperforms the S&P, and it's only outperformed in 2 out of 9 months in the month of June. Not much better in September, only 3 out of 9 months with no excess return, which is unusual because you look across the board, and technology over the last 10 years has done very well. It's the leading sector. So when you look at this, you would think, okay, well, if every month is equal, I should see, technology doing well every month. Well, it really doesn't. And, that can be a problem. Now, in the summertime, when things tend to get slow, I find this very interesting, that throughout the secular bull market, the summer months, July and August, have been very good to technology. So we do have that to look forward to. Anyhow, that was technology. Let me just do consumer discretionary. This one I'm actually pulling up for the first time. I haven't even done this one myself, not over the last 10 years. So I just was interested to see how this worked out if we added up the same thing. So I'm just marking this down in my own journal here. But okay, so the XLY, if we add up the first month, 2.1, 5.7, 8.5, 8.6. Almost the same as technology, which was 8.7. So 8.6%. Second month, 1.3 plus 4, 1.7. 1.1 is 2.8. A big November. So that's 6.7, which was worse than the technology. And then let's go into that no man's land. Third month, 0.2. June's not bad. 1.9, so it's 2.1, 2.7. And 0.1, 2.8. So it's, very similar to the technology group. The only thing I would say is that second month of each quarter is where technology kind of pulls away from consumer discretionary. That was 9.6 for technology, and it was 6.7 for discretionary stocks. But the overall theme remains the same. Both of these aggressive sectors that have led the S&P 500 throughout this secular bull market the last decade, both of them tend to get most of their gains in the first and second months of calendar quarters. Here we are starting the third month of a calendar quarter. We're in March. So just keep this again in mind. I think it's really important that we temper our enthusiasm for this month, because historically the market tells us that's what we should do. And we've had a big run up. It's okay to consolidate for a period of time. All right. I mentioned earlier I wanted to talk a little bit about the renewable energy space. So let's pull this up. Now, one thing you have to understand about renewable energy is it has been on fire for the last year. 1 year ago, less than 1 year ago, middle of March, when we reached the bottom, this index was down at about 60. At our recent high in less than 1 year, we went to 425. And the other thing I would say is at this last high, do you see the higher prices here and you see that negative divergence coming in? Now, negative divergences aren't always, I wrote one article last week in my Trading Places blog. I'm going to write another one. This isn't the most important signal in the world, but it is a little caution flag, that is raised from time to time. You need to at least be aware of when the stock market is telling you that your stocks or the industry groups that you've been looking at or investing in are starting to show signs of wear and tear. Now, do I think that renewable energy is done for the next year? No, I don't believe that. I think many of these companies will continue to grow their earnings in a low interest rate environment. But they probably got ahead of themselves. I mean, again, when you go from 60 to 425 in less than a year, you better have some crazy growth and you better not have any bad news stories because you're priced for perfection. So I just think we're probably going through a period here where we're going to see maybe either an inverse head and shoulder, possibly a cup, something like that form. And when you look at this daily chart from a short-term trading perspective, I would say, yeah, renewable energy's got some issues here, short term. I mean, we've had the negative divergence. We lost the 50-day moving average. We did have a big reversal with that hollow candle. So now I think we've kind of set our line in the sand. And you can see that prior high there was about 255. These lows were about 255. This low is about 255. Don't be surprised if we work our way back down to about 255, especially if March is, somewhat weak or maybe on a relative basis. Money rotates out of growth for a bit longer. I could definitely see renewable energy back at that 255 area. And that's another 12, 13% from where we are now. And we lost 4% yesterday. So 2 or 3 more days of yesterday and we'd be there. I don't know that that's going to happen, but we'll see. Certainly the market is set up here for renewable energy to weaken. Sometimes when I look at a chart, though, that is beaten up in the short term, doesn't look so good, I think it's good to step back and maybe look at how this weakness fits into a long-term picture. And so I would personally go into something like a weekly chart. And when you look at a weekly chart, you see, wow, you see a negative divergence here? Because I certainly don't. Now, some use these crossovers as negative divergences. The way I use divergences is I look at where the most recent high was. So in this case, that 425 high. And I look at the PPO. Is the PPO also at its highest level? Yes, it is. Then to me, momentum is strong. And when you get a pullback, I expect that rising 20 period moving average to hold. So far, it has. Now, again, intra-week, could we go back down to 255, 255 area? Quite possibly. But the long-term chart makes me more bullish than looking at that daily chart, because the daily looks like we've broken down. The weekly looks like we've already hit our support and we're ready to bounce. So again, I think it's all based on your perspective. If you got into renewable energy when we were at 420, you probably think this is the worst area of the market. I mean, you're down from 425 down to say just 300. That's 125 points. That's 30% in 3 weeks. But when you get into areas of the market that have risen this much, again, it's all perspective. We only went with one renewable energy stock in our portfolios, and it wasn't because I don't like the group. I like the group. There were just too many warning signs. The negative divergence being one, the fact we've just gone up so much. And and to be honest, some of the individual stocks bothered me. So we kind of put the brakes on this group for now. So if this consolidates and looks pretty good come May 19th, it's very possible we could have 2 or 3 of these stocks back in our portfolios. But for right now, the group just is a little bit, makes me a little bit nervous. Now, one other stock, and this is a stock that I got a couple emails from members about, Zoom, which reported yesterday. And hey, this is an ugly candle. You can spin things all you want, and I'm pretty good at spinning my bullish cases, usually with facts. But when you look at a candle like this and you see that kind of volume, you think to yourself, okay, that is just, it's not good. Couple things I'll say here about Zoom and just technical analysis in general. When I get a good earnings report and we're getting a gap up, I like to see where we open. And I think this is a pretty good case here where we had, I mean, this earnings report, I don't know if you looked at it, but it was awesome. Their revenues crushed expectations. Their earnings crushed expectations. $1.22 versus 79 was the bottom line. I mean, and I'm going to show you their earnings growth in just a minute. But this was a great report. But technically, and it was set to open, if you looked at the after hours on Monday after the bell, they traded after hours up around 450. And when I looked at this chart, I was like, man, if this stock opens at 450 and can take out that mid-February high, I think it's going to go. I think it's going to zoom, no pun intended. But it didn't. It opened at 440, 439. And literally yesterday had a total of 40 cents of upside at the very opening bell. And then if you watched this stock yesterday, it was down all day. Trust me, I was watching it all day. And if you look at this chart, I mean, it didn't catch a bid all day. Now, some might look at that and say, well, that's just really bearish. And short term, I can't disagree. I mean, how can you disagree with a day that looked like that? But I also, my fundamental side comes out, and I know how market makers operate. I know their job is to get the best price they can possibly get for institutional clients. I believe institutions want in to Zoom. Those that don't have it, I think want it. And this is one way to really discourage a lot of individual investors to have a day like this and just see it just going down every day. I mean, if you bought in at the open because, hey, they had great numbers and I'm going to, ride this to the moon. If you bought at 440 or 439 to open the day, by the time this closed at 372, I mean, it was despair. I mean, that's $68 to the downside, which is better than 15, maybe 16% in a day from the opening bell to the close. And I look at this and I just think, wow, that was quite a round trip from where we were at the end of last week, closing at 373, having the huge day on Monday, having the gap up with earnings, and then this huge sell-off. We were right back to where we started. But psychologically, I would say the psyche of most individual traders and how they're looking at Zoom right now as to how they were looking at it 2 days ago is probably different. And that's what market makers will do. They will completely change your feelings about a stock from the opening high, the high not only from price, but the high that you have from just having a stock that's gapping up like that. You're feeling pretty good about it, to where the stock ended. Completely different feeling about the stock. And yet, fundamentally, nothing changed. Let me show you some numbers here. This is just off of Yahoo. If you go in and search for their Yahoo earnings calendar, it'll bring up this page, and then you can come in and you can type in whatever you want in here, whatever stock you want. It'll come up and bring a history. Look back at what Zoom did a year ago. Before the pandemic, look at their earnings. 1 cent, 1 cent, 3 cent, 7 cent, 9 cent. Then the pandemic hit. And look at how their earnings have exploded. 45, 76, 79, 93. Now, those were the estimates. This is the actual. Look at this. So they beat every single quarter they've beaten. So when they give you an estimate, I love company that always beats, because usually you're going to get run-ups into earnings reports, just like we saw on Monday. Big earning run-up into earnings. Why? Well, anybody who knows the stock knows that they generally beat. So look at the numbers: 3, 8, 9, 15, 20, 92, 99, $1.22. Not only do they beat, but they blow out the numbers. Never, not even once up until these last 2 quarters. Every single quarter, they at least doubled the estimate. And in the last 2 quarters, the estimates got raised quite a bit, but still they're coming in way above estimates. So when they say the next quarter's estimate's 93 cents, and I look at these numbers, I'd be shocked if they don't beat 93 cents. I mean, I'm probably going to come in $1.40 or something. But looking at the fundamental picture and then looking back at the stock, and I'm going to go out to the year chart. Keep in mind that a year ago, Zoom was at $100 and it went to almost 600. It went up 6 times. So the market's anticipating all of this growth. And then you go through these periods of consolidation where it just wears individual traders down to the point where they see everything else going up and Zoom's not, so they sell. And then you see a gap up and it's like, okay, finally we're going. And then they see selling and they sell. I mean, that's the way the market works. That's the way market makers accumulate shares. And that's the way they can then provide those shares to their institutional clients at cheaper levels. Now, when all of the sideways consolidate, and this is based, I guess, a little bit on my bullish bias on the stock. I believe Zoom's going higher. But I believe once all of this plays out over time, and I would probably, I've been viewing 325 as like the bottom on Zoom. That's where we gapped up on massive volume back in September. And we haven't even gone back and filled that gap yet. But I believe that was the biggest volume on the stock was that day. So I believe if it got to 325, you would see tons of interest in the stock. And this whole process here is wearing people out because you're not making money while the market's going higher. So you get tired of it. You want to go chase something else that's working. And eventually market makers will get their fill. And when they get their fill and institutions get their shares and the supply dries up, that's when you're going to see Zoom making more of a move to the upside. I still believe that we're probably in this cup phase on Zoom. Would I rule out 325? No, I wouldn't rule out anything, especially being in March. And especially seeing yesterday's short-term candle, no, I wouldn't rule out the possibility that we see 325. I mean, anybody buying at 430 or 440 and seeing 325 is going to be bailing. They're not going to be happy. And so I think eventually market makers get their fill of shares, and then I think the stock turns higher. I spent a lot of time on this, but I've also fielded questions on Amazon, which I would kind of be put in the same camp. Amazon, it's a massive sized company and it doubled in 5 or 6 months during the pandemic, 1,700 to 3,500. And so what's wrong with Amazon? 6 months, it's gone nowhere. Market keeps going higher. It's consolidating. When the consolidation period's over, institutions have their fill. I believe you'll see Amazon break back out again. I don't think the run in Amazon's over by any stretch. Now, it's not been a very good relative performer for a while now, so I'm waiting. Don't have it. It's not in our portfolios, but it is a stock that I believe in longer term. I think it'll be a really solid player here soon. But for now, it's frustrating because it's not going anywhere. It's not breaking out. Anyway, that was a lot, and I went over that, spent a lot of time. Let's just go quickly through 3 earnings reports. So we'll make earnings our 3 you must see. First one, I'll mention, this was a big software company I was watching for after the bell yesterday. They beat 78 cents versus 68 cents, but right now the market doesn't care. It'll care in time, but this is another stock literally that's just been going sideways. Another frustrating software stock, but just when everybody gives up on software, that's when the stocks will take off again. So not a great reaction, but a pretty darn good report, 10-cent beat on the bottom line. Second stock, this was a big miss, and I was wondering how this stock would perform today. They were expecting $1.03, and they came in at 67 cents. Now, this is another one that's been in a little bit of an uptrend, maybe a cup handle. I'm not sure I'd even call it a cup and handle anymore because of this breakdown today with its earnings. I think we're likely to see the stock move back down toward the 105 area. Missing earnings like that, it's obviously not going to be on our strong earnings chart list. I'm not going to try and catch a bottom on this one. I would be just biding my time. And then the last one was one that reported this morning, Dollar Tree DLTR. They beat 213 versus 212. Stock did gap down, but it's trying to recover. Possibly could hold this gap support area. This one of the 3 looks the most interesting from a short-term trading perspective, because if it goes back down below today's low, I'd probably be out. It is in the specialty retail area, and retailers haven't been doing very well. Yesterday, it didn't do well at all. And so we'll see how the group does, how it fares today. But, longer term, we're going higher. It's just that on a relative basis, this is a group that's been struggling last few months versus the S&P 500. So anyway, that's how the market looks. Let's get a quick market update. We'll wrap up. Dow right now up 85, S&P up 3, NASDAQ down 1. So definitely better than what the futures were saying. Small caps, mid caps doing pretty well on a relative basis. And that's been a theme now going on for quite a while. So overall, not bad. Keep in mind, this is a bullish week for in March. So March 1st to the 5th is the best week, best period in March historically. And that goes back not just the last 10 years, that's the last 70 years. 70, not 70 years. So pretty long-term track record that I'm looking at. And beginning of March normally is pretty good. So we could still, maybe move a little higher this week, but just keep those earlier charts that I showed you on seasonality in mind, because I do think that could kick in throughout the month. And without that knowledge, you might get really frustrated. You might start thinking, hey, the market's run its course. Just understand March does this quite frequently. And so if we do see some weakness, I wouldn't be overly concerned. Just keep it in mind. Anyhow, that's it. Tomorrow, I think when I do the Trading Places Live over at Stock Charts, I'm going to show you some things, how you can use some of our chart lists and how I use them, and how you can, just kind of think intuitively about the market, and how you can use some of the research that we do that can help in your trading or investing. So I've kind of got that written down. I was going to go over it today, but ran out of time. So I think I'm going to make it a part of tomorrow's show and just lock it in. So definitely tune in tomorrow if you can. Everybody have a great day, and I'll be back over at Stock Charts tomorrow for your next Trading Places Live, 9 a.m. Of course, as always. Happy trading, everybody.